then I'll start working through any questions. Did you have some questions that you wanted addressed up front?
Yes, I'm a little bit with the T accounts.
Yes.
When I fill in the questions in the homework, every time I think of the T accounts as the account equation. So to think about what side of just say what side of the T account that either equity increase or something decrease.
Yeah.
And when I think of it that way, I got it right. But sometimes when it thinks about something like if it talks about the expense account or the equity account and asks about something, is it an increase on the T accounts on their whatever? I always get it wrong. So I'm a bit confused which one does it mean? Or
yeah. Great question. Let me just double check something here real quick. In my week 3 deal, let's see, accounting equation examples, chart of accounts and accounts. Okay. So now there is I'm not sure if you've seen this. I'll do a video. I'll explain it here, but in the supplementary study materials for the week, I highly recommend, especially since this chapter, they give you a full week and a half effectively to work through. I highly recommend going through these study materials. It walks through like, T accounts, types of accounts, journalizing, posting, trial balance, and financial statements. Everything is right here. Very concise, easy to follow, and to check your understanding as you go. Okay. So that's just a little caveat to what I'm going to do here in just a second. But definitely utilize those. But I will do my own version of this. I've already got one over in the playlist that goes over a chart of accounts and accounts, but I'll do a kind of a beginning to end. I've kind of hinted at this before in some of the work that I've already done, but let me do a little kind of beginning to end scenario again. Repetition is always good. And I'll try to incorporate more of, more of we'll start out with, let's start out with the most basic starting point, accounts, right?
Yes.
So the reason why accounts are important because they're basically buckets where we put money or where we put value in, right? And you can either have accounts you can have asset accounts.
Yeah.
You can have, let's do this in the accounting equation, equals, you can have, oops, didn't want that, equals, let's do liabilities here, right? Plus, oops, wrong plus equity, right? So our accounts on the asset side are going to be like cash accounts. We're going to have bank accounts, which are theoretically cash accounts as well, but I'll just put bank in there. We have inventory accounts.
Yep.
We have accounts receivable. Okay, we have equipment. And we have, I'm gonna put in here accumulated depreciation is an asset account. We have, let's say patents, maybe one, and let's do another one. Let's just call it goodwill. Okay, so these are your typical kind of accounts you'll see day in, day out on the asset side. Okay. On the liability side, you have accounts payable, you have notes payable, you have salaries payable, you might have taxes payable, and let's throw another one out there. This is called which one do I want to do? Oh, let's do unearned revenue. Okay, is a liability account. And then on the equity side, you're going to have common stock. Oops, You have common stock. You can have paid in capital common stock, which is, and you'll get into this a little bit longer later, a little bit more. You have dividends. And you have, let's call it just retained earnings. Those are your earnings. Okay.
Yeah.
Those are some of your primary accounts. Now, typically, for most accountants, they're familiar with not only the account names, but also numbers. So like this might be 110, this might be 120, this one might be 130, this might be 140. Oops, 1040, sorry. 1040, this is maybe 1050, this might be 1051, 1060, and I'll explain why the one. 1070, okay? That might be the numbers for those. And let's call this one 2010, 220, 2020, 2030, 2040, and let's call this 2050. So we might assign, these types of numbers, and equity would be 30, 10, 30, 20, 30, 30, and 30, 40. And you'd also have, which rolls into retained earnings, right? You have your revenue accounts. So let's call it sales revenue, and let's call it returns and allowances, which would be an offset to revenue. Help if I spelled right, returns. And okay, and you might have some expenses. So you might have salaries, expense. You might have rent expense. Oops. You might have utilities expense. I'm building up to this. You'll see where I'm going here in a little bit. Utilities, office expense, travel expense, marketing expense, plenty of others. I'm just gonna leave it there. Okay, and these might be like, this is be 410, maybe this is 411, and let's call this one 510, 520, 530. And of course, I'm always missing the zero when I say five, but 5040, 50, 50, and 50, 60. Oh, and there's other expenses like other income, other expense, and they may have tax expense. These are usually other income and expense, and they'll call these something like, let's call this one 610, 620, and this one, oops. Let's make this 720, and this is 730 for whatever reason. Don't worry about the numbering. Just usually assets are ones, liabilities are twos, equities are threes, revenue type accounts are fours, expenses are fives, and any other can be either 6 or 7. Some companies do 8 and 9s. It just depends on how many different categories of expense they have. In fact, let's just do it what normally it is, 8. It'll be something like that. Okay.
Yeah.
So that's your chart of accounts.
Okay.
Now from there, you have to realize that any asset account generally is a debit balance, normal debit balance. A liability is usually a normal credit balance, and an equity account is usually normal credit balance. Except all these right here are usually a normal debit balance because they're expenses. Okay, so this is a credit account. These are credits. These are debits. Reason why they're normal credit, because you expect to have a profit, right? And profits add to retained earnings. And because they add to retained earnings, it's a credit. So that's why you typically have, credit revenues are always a normal credit balance, and expenses are a normal debit balance. So that's how it all flows in this side of the equation. What that means, though, there's a couple that are a little funky. They're called contra accounts. I'll put these in red. Contra accounts means that effectively they do the contrary to what the other accounts do. So in an asset account, the normal balance is a debit. The normal balance is a debit. Whereas in accumulated depreciation, it's actually a credit is its normal balance. And dividends is the same thing. The normal balance is a credit. A debit. It's the opposite of what the normal account would be under equity. And so these are exceptions to the norm, and which is why they call them contra accounts, exceptions to the norm for that set of accounts. And it's important to know because a credit to any of these accounts will increase the balance. A debit to any of these accounts will decrease the balance. Same with these. To the opposite, a debit to any of the asset accounts will increase it, and a credit will decrease it. Okay, so that's your normal account balance description, whether it's debit or credit. So with that in mind, all right, we got our chart of accounts, we've got our balances, whether they're normal debit or normal credit, and whether they're a contra account. Those are your basic summary pieces of information. You following me so far?
Yes, yes. So with the debits are always the ones that we take away, we pay, or we sometimes I always look at credit as something that is added, and the debit you have to be taken away.
Yeah, that's you kind of have to forget that for now. Okay. Yeah, you have to forget everything you know about what a debit and a credit is, because usually it's your understanding of it is based on whether you're a debtor or a creditor. Most of us are debtors, right? And so we think of credits as things that come back to us. And because what happens is if it's coming back to you, like let's say, the company is crediting your account. Well, they're reducing your accounts receivable. They're reducing the amount you owe them, right? That's why they call it credit. It reduces your balance, but it also on their side, it's a positive to you, but it's a negative to the company. So you have to just kind of ignore the whole the way we typically think about debits and credits. Try to. I know it's hard, but think of them in this fashion. Account has a specific type of normal balance, debit or credit. Depending on what the type of account is, it increases it or decreases it. And so you can't always equate a plus with a debit or a negative with a credit, right? Because they're different. And I'll show you that to you here in just a second. I actually think I did this a little while ago in one of the other videos, but I'll do it again. Okay, so let's do journal entries, right? I'm gonna move these around a little bit. Sorry, give me some room. I'll move these over here. That gives me some room. Okay, so almost in the olden days, okay, you might have ledgers, right? Books. And those books would have on them, let's just think of it like this. I have a cash ledger. I might have let's call it a accounts receivable ledger, right? And each of these ledgers, by the way, let me just each of these ledgers would do something like this. They would have a date on them. They would have a description, right? Description, back in the old days, a description. They might have an account, and they would have generally 2 columns on them, an increase and a decrease, but we're going to call it a debit and a credit because we don't know whether it's an increase or a decrease. Okay, they would have this. And so now that I've got my basic setup, let me just do one other thing. I don't know if I can do this. Yeah, I can't. Okay, so Let me take this off. Okay, so now I've got these two accounts, right? These two ledgers. And I would start recording things in one ledger. Let's say let's do another one. Let me copy this one. Over copy, and let's create a copy at the end. And let's call this one equity. I was going to do some very basic things that they would do. So old days, they'd say, okay, on one, oh, come on, one, there we go, 1-1. I invested in company. Okay. And it's already in the equity account. And so I'm going to put it in the cash account, and I'm going to put $1,000 in it. Okay. Then I come over to the cash and I do the same thing. One invested in company, and this would be from equity, and it'd be 1,000, something like that, right? So now my ledgers balance. If I go to one or the other, they all balance. Kind of old school. So the way that really looks like over here in a combined journal entry, these are journal entries, is on date, account. We're just going to do this a little bit more simple. Debit, credit. I won one, and see, we're going to go to cash. We're going to go equity. I invested in the account, right? $1,000. Oh my goodness, sorry. Company. And we're gonna italicize this. That's the description. Okay, so this is called a journal entry, and it's double-sided, balanced. So I have equal amounts of debits and equal amounts of credits, right? Okay, so all is good. It's the same thing as my ledgers, but we wanted to summarize this somehow. So we started to create these T accounts. So that's journal entries. We'll call these T accounts, right? So I have a cash T account, which has a debit and a credit. And let's just put a reference here for grins, REF, oops, REF. Okay, and I also have, I'm gonna do a couple here. Let me move this out of the way. Move this out of the way over here. Okay, so I have T accounts. Let me set these up right so that they make sense in the long run. I can change these once I got them set up. Okay, and I want this to be underlined right there. Underline. And we're just gonna do a couple of these. So we'll do that. We'll do a right, a left, no, and we'll do a right. And this will be a bottom. Okay, there we go. So this is a T account. Okay. And one thing I'm going to do here, because it's a normal debit balance, I'm just going to go ahead and do a bold right here. It's a normal debit balance, cash, right? Cash has a normal debit balance. Yeah. So then I'm going to do equal sum. I'm going to sum all this side, and I'm going to minus the sum of all this other side. So anytime I do any transactions in here, it'll be easy for me to just see what the balance. That's a normal debit balance. I'm also going to create one of these for AR. And let's create one for AP. Accounts payable, right? But instead of a normal debit balance, this is going to be a normal credit balance. So I'm going to give you the full view. And instead of this being here, I have to come over to the credit side, because that's the side that we're going to do. And we're going to do the formula a little different. We're going to sum this side minus the sum of the debit side. So just the reverse, right? So in this case, I'm summing this side and I'm subtracting this, and then we'll do this one more. We'll do equity. We'll do actually common stock. Okay, oops. Let's copy this over. And so this is going to be exactly the same. It's going to be a credit balance, right? Because my credit, normal credit balance here, normal credit balance for liabilities, which is accounts payable. I'm actually going to change this to common stock. Oops. Okay, so this first entry, we're going to call this, let me put a little insert here. We're going to do a little reference right here. And we're going to call this A. Okay, so for reference A, we're going to put 1,000 here. Oops, 1,000 here. And we're going to go over to common stock and we're going to put 1,000 here.
What?
Right?
Oh, yes. If we don't have a bottle.
There we go. Okay. So theoretically, right now we balance because all of our asset accounts equal. Oops. Equals AP plus common stock, right? Same accounting equation up here. We're just replicating here. So cash plus, and this one plus AR equals AP plus common stock.
Yeah.
So 1,000 plus 1,000, we're all good. You following me so far?
Yes.
All right. So invested in stock. B, we're going to buy something, right? So on 10, we're going to purchase. In fact, I know I did this before, but that's okay. Purchase. What do we want to, what company do we want to buy or set up? What are we going to sell?
Supplies.
Supplies?
Yep.
Office supplies. So purchase, let's call it paper. We're going to be a paper distributor. So we're going to purchase some paper and we're going to sell it. We're going to buy it. So we're going to do this on accounts payable. So we're going to buy it on accounts payable. But this is going to go off. Let's go to, oh, I don't have inventory. It's really sad. Let's move this over. One more. And we'll maybe make these a little bit smaller. One, two. Yeah, we have enough. Okay, thank goodness. We have enough for one more. We'll do inventory. Okay, now we can do this. So we're going to go to inventory for the paper and we're going to come out of cash. And let's say we buy $100 worth of inventory, purchase paper, $100. Okay, so on B, we're going to have inventory here at a 100. And we're going to have accounts payable. We didn't do it with cash. We did it with accounts payable. Sorry. We're going to do accounts payable for 100. Okay. We still balance here, right? We balance here. We balance here. These are our T accounts. All good?
Yes.
Okay. And then we go C. Let's say on 115, we sell paper. Okay. So we're going to do revenue. I'm gonna have to create another account. That's okay. We're gonna have to do sales revenue, and we're gonna do accounts receivable. We're gonna do it on credit. Okay, so we're gonna sell it for 2 times what we bought it for. So let's just call this AR. Actually, we're gonna swap these around. Usually do debits first and then credits second. So you kind of have to know that, but you don't have to. If you're a little off in the formatting, that's okay. AR is going to be a $200 debit because it's increasing the value of accounts receivable. And we're also increasing sales because that's a credit, $200 there. Yeah. So on C, we're going to have this 200 here. And we're going to come over here to, we're going to create this. And we're going to call this, sorry, column width 2, 4 doubles what we just did. This is going to be revenue. Okay, take that away. So now revenue is $200, and that's going to be right here. So you notice that this balances out as well, $200 on the debit side, $200 on the credit side. So we're all good.
Yeah.
And let's do one more. What are we going to do? Oh, and somebody pays part of their accounts receivable. Pays portion of accounts receivable. Let's move this down. Somewhere around here. Let's see, on 130. Okay, so it's going to come into cash and accounts receivable. And let's say you only pay $100. Okay. So those are a series of journal entries that now find their way to a trial balance. This is 100, right? And inventory is a minus 100. So we balance on this side because the debit is an increase, a credit is a decrease on the asset side. So these balance, nothing has to be done on this other side. Those are your journal entries. These are your T accounts to summarize those into one nice little area. You notice that on the cash, I've got the 1,000 plus the 100 adding up to the 1,100. On the accounts receivable, you have the 200 minus the 100 equals 100. And any other credit on the other side just increases the value of the liability or the equity type accounts or revenue accounts.
Right.
How's that?
Yeah,
Did I answer your questions? Any
yes,
questions
yes.
from there?
Yes, I think I didn't really look into details at that's the trial balance.
Ah,
Yes.
okay.
Yeah,
So now the trial balance,
yeah.
if we were to do a trial balance, very, very good. Okay. So trial balance would then take these accounts, cash, accounts receivable, inventory, accounts payable, common stock, and sales revenue. Okay, we would have, let's move this up. We'll bold that. Whoops.
Yeah.
We'll bold that. Actually, kind of do a proper one. Okay, so let's do this as of 130. Okay, and we're going to have the account. We're going to have a debt. Let's see. Make that a little bigger. We're going to have a debit and we're going to have a credit. Okay. I'm kind of doing the truncated version of this. Oh no, I wanted to keep that there. Let's bring this down here. Okay. So now we have our accounts. Put a little underline in here just to kind of give you a rough sense for what this is. So cash is we're going to pull this number, right? AR, it's a debit. It's going to be over here. Inventory is going to be right here. Accounts payable is on the credit side. So we're just going to bring this number over from there. Common stock is going to come from the common stock number. And sales revenue is going to come from the sales revenue trial T account. Okay. Now, if we total these, they should equal.
Yeah.
Hence, it's called a trial balance. They equal.
Yeah.
How's that sound?
Yeah, that makes sense now. Like, yeah, to have that each account has its own T accounts.
Yes.
Like how we look at the credit and debit. Yeah.
Uh-huh.
Okay.
Yep.
And then when we put them all together on its own, on the where it's supposed to be, then we could get our balance, as trial balance.
That's right. The trial balance is done so you can double check that all these values add up to they're equal, right? Your debits equals your credits.
Yeah.
That's all it's double checking. If we got something wrong here, so let's say I got one of these transactions in here, but I forgot to put the opposite side. So let's say I forgot this one right here, right? I forgot to record this one on my T account. Well, you'll notice now that we're out of balance.
Yeah.
Right? Check
Yeah.
figure. So if I do, that minus that, I should be zero, but I'm $100 off.
Yes.
So then I have to go back here and I say, okay, well, where did I mess up? I messed up right here. So I have to put the 100 in. So once I put the 100 in on the T account, it'll transfer to the trial balance, which will then zero out it'll show that I have a zero and therefore I balance on debits and credits.
Right. That's amazing.
Okay, so for those that are watching, I'll just make these nice and colorful as well. This one will make a nice, wonderful orange so as to not suggest that one's good or better than the other. And we'll make this one a nice, lovely, do we have purple? Yeah, let's do purple. Okay, there we go. Those are your normal balance indicators.
That's so good. Like
Okay, so in a nutshell, I think in 30 seconds or 30 minutes, I just covered let's go over there if I can find it. In these supplementary study materials, I did a quick review of debits and credits and T accounts, types of accounts, journalizing and posting, trial balance, and I didn't do the full financial statements, and debt ratio. That's pretty easy.
all right. Well, thank you.
Yeah, debt ratio would just be, in this case, sorry, let me find my thing somewhere around here. Where'd I go? There we go. Excel. Trial balance would, no, debt ratio. Debt ratio, liabilities divided by assets. So in this case, liabilities divided by assets. Your liabilities are going to be this one right there, divided by the sum of your assets, which is actually this number, actually. I don't need that. That's your debt ratio. That's pretty good. Okie doke. Any other questions?
No, wait, I just noted on something, but I'm not so sure. Like the it's just some few little things like when they're doing does the assets account, does assets cause equity to increase? Sometimes like I knew that the equity increases with the what's it called, common stock and revenues,
Yeah.
And sometimes I think of in the transactions belongs to an asset. For example, like if I increase in cash, if I increase the cash value, that is an asset
Yep.
account.
Yes.
Would I get it right if I say that asset increases revenue? I mean, increases equity?
Usually, I would usually say it the other way around. That increases in equity oftentimes increases your assets.
All right. Okay.
Oftentimes, because like you saw it right here, right? An increase in common stock, meaning I put money into the business, resulted in an increase in cash, which is an asset, right?
All right.
But you can also get increases in cash by borrowing money too. So increases in accounts payable or increases in notes payable would possibly increase either a cash account, or it could increase an equity account, and excuse me, not an equity, equipment account, right? So your increases in your asset accounts will almost always come from increases in your accounts, in your liability or your equity. You just don't know exactly where. You have to, read the description on what happened. decreases in your asset accounts generally result in decreases in your liability or your equity accounts. So they will fluctuate up and down together. Hence the reason why we have the trial balance, which gives us, they always have to be in balance. So one or the other is increasing at the same time the other one is. The only time you will get, and actually, no, let me think about this. You may have some transactions that have no impact to either one. It's a net amount, and that's like this one right here, right? So when I received cash on from somebody that owed me money, it decreased accounts receivable, right? But it increased cash. So there was no change to assets and no change to any other account either, liability or equity. It was just a swap of assets.
Yes, yes. I think sometimes I get that. I miss that one when we do the one in the homework and the quiz, because sometimes I knew that when they are in the same, because they're both assets, and once they pay the accounts receivable, the cash go up. But sometimes I thought, hey, it has an impact on the other side, but definitely it doesn't.
Right, exactly. You can move money within assets or within liabilities, or even within liabilities and equity, right? And they'll have no impact on the other side of the equation.
Okay.
This being, the midpoint.
Yeah,
it doesn't always. It doesn't. This little seesaw doesn't. It always needs to stay in balance, and so it doesn't necessarily just because you changed it here means that you changed it here. I mean, sometimes it just changes on this side, on one side or the other.
Okay. One last question is the cash balance. I think the cash flow statements, like like, so it just concerns only cash, nothing else. Cash outflows and inflows. It's just
it's just cash. But it doesn't necessarily look at just your T account, if you will, for cash. That might be a summary of the individual transactions, but usually a cash flow statement. If I go back here, let's see, let's go to a cash flow statement. See if financial reporting. Does it give you a summary here? Let's see, cash flow statement. Statements from trial balance. They don't do the cash flow statement here, but the cash flows statements here, right? They're usually going to start with a net income. Where did they go? No. Hold on. Indirect, direct, 3-step, 3 using cash flow. Let's look here. There we go. No, close. They use balances from here. Here we go. Here's a statement of cash flows. The top part. They'll start with a net income, usually from the income statement, and then they'll make adjustments based on changes to specific accounts within the balance sheet. And then they come up with a net operating income, a net operating cash provided by by operating activities. They do the same for financing activities and the same for investing activities. They just don't necessarily start out with net income. They just do changes in balances. It's a little complicated. That's why they didn't go through it in too much detail in chapter 12, but they do ask you general questions about how it comes together.
It's all right.
It's Statement of cash flow is probably the hardest one to put together. The other ones are pretty straightforward, your financial statements.
Mm.
Right, so financial statements. There's your trial balance. So this is your trial balance. This is exactly what I just did, right? Accounts, debits, credits, all equal the same number. And then you get your, balance sheet, income statement, and all these other statements in the back. And they kind of show you, this is kind of a complicated diagram to figure out. You got your trial balance here. These are all your accounts and all your balances. And then they try to show you where certain parts of them, like all the revenue expenses, all these count balances come over to your income statement. And this is how it's formatted. Your retained earnings really takes just your beginning retained earnings value plus your net income, which came from your income statement, minus your dividends, right? So it's kind of really a combination of this one and that one. And your balance sheet is just this, is all these other accounts, but just formatted as assets, liabilities, and equity, with retained earnings coming from your statement of retained earnings right here.
Bravo.
So this is one thing to keep in mind. If I were doing some of these assignments, like the quiz access, for example, I would have this on one side of my screen, right? And then I would have, where's my, where'd it go? Wrong one. I think it's this one. And then I would have, for example, let's say I came in here and I was doing chapter 2 and I was doing quiz access, right? I would have this, my other, or, if you don't have this big of a screen, you might have a smaller screen. I would just have both of them open so that when I get to a question on like the financial statement, right, it's probably one of these, right? It gives me the data and then it says, hey, guess what? Fill out your income statement. Oh, wow, look at, I've got a format for an income statement right here and I can just follow it to the T.
Yes.
Right? And then same with like this is going to say do a retained earnings thing. Oh, this is what retained earnings looks like. Okay, so I can just fill it out here with the information I have above. And the same with, guess what? Balance sheet's going to be there. There's a balance sheet and here's all your balance sheet formatting, right? And you can do the exact same. So you can use, especially in the quiz access and the quizzes, you can use as much notes as you need to get through it. And the easiest thing to do is to come to these graphs, these exhibits that are in McGraw-Hill. In fact, as just a little side note, the summary cheat sheet is on every single chapter. And if you bring that up, it gives you all the definitions. It gives you more information about T accounts. It gives you how to record specific types of transactions, right? And what do you know? There's financial statements. So you can actually pull up this cheat sheet and have it right on your, for the quiz and quiz access, you can have it right here on your computer and reference it as you're going through each of the problems.
In the exam, it's not open book, eh?
Yeah, exam's not open book.
Okay.
So it's a little bit of a crutch. You probably don't want to use the crutch too much, but as in these initial chapters, it'll become very helpful to be able to refer to something as a guide on how to complete the work.
That's good. Yeah, I've been writing some of the things down and refer to them. I think that's, yeah. Well, I think that's just those things. I wasn't too sure.
No, I'm not confused.
But I just go through the assignments, the quizzes and things, and just always refer back to my reading, to the reading.
Yeah.
Things, everything carefully.
But I think this cheat sheet is going to be really helpful for you I mean, it is good to write things down yourself because writing it personally commits it to memory a little bit better than having a reference sheet. But if you do need it, it's there, right? And you can use it. Okay. Any other questions?
Now I think that's all.
All right. Well, if you have any other questions, there's always some videos in here, right? There's office hours from last semester, so I probably covered some other questions in there. There's a chapter 2 review that I've done, which is going to be similar to what I just did here. Some accounting equation examples, which are going to be similar to what I've done here. Chart of accounts, similar. Let's see. And then Smart Book number 2. It looks like I went through some problems that you find on Smart Book if you're interested, and you can follow through that. Okay.
Okay. Well, thank
All right.
you.
You bet. Have a good night or day.
Yeah, good to you. Okay.
All right. Bye.